CA Arpit Haldia from Jodhpur. Will be focusing on the analysis and impact on the hospitality and hotel sector. So this session has a very good response in terms of the analysis and the conclusions what the members are getting from the industry-wise analysis done by the members at large. So keeping this as giving this as a background, I will request Nishant sir to give a formal introduction to our esteemed speakers.
Good evening, everyone. I'm pleased to be part of CGPI to introduce Preeti ma'am. Preeti Makija is a chartered accountant and she has secured all India rankings in her CA examinations. She is currently part of CNK and Associates LLP and has also been part of their technology related initiatives. She has more than 14 years experience in indirect taxes, working across the wide spectrum of industries and demonstrating her versatility and in-depth understanding of complex tax matters. She has actually successfully navigated intricacies of indirect taxes across a range of sectors, including aviation, financial services, manufacturing, real estate, power generation, logistics, and BPO. She's also part of, she's a regular speaker on indirect tax matters at various forums, including ICI, internal firm trainings, as well as client-facing knowledge sessions. These brief introduction, I would request Preeti ma'am to take the charge of the
transactions மட்டும் இது பண்ணனும்னா இந்த காலம்ல போய் நான் ஃபில்டர் பண்ணனும்.
Nishant, I think somebody is there. Yeah. Thank you, Nishant, for the introduction, and thanks everyone for joining this session even on a weekend at 5 p.m. And I hope I make a justice by giving the insights which you are all expecting. It's a privilege to be here today at the series jointly, which is organized by Confederation of GST Professionals and Industries and Maharashtra Chamber of Commerce, Industry and Agriculture, focusing on industry-wise analysis of GST 2.0 reforms, which were announced on 3rd September 2025. The transport and logistics sector is one of the beneficiaries of the GST rationalization. This is because logistic industry sits at the very backbone of the trade, whether it is moving raw materials to the factories, finished goods to the market, or passengers across the country. The GST 2.0 reforms are not limited to rate cuts, but focus on making the tax structure clearer and smoother. For the transport and logistic sector, these changes will help improve efficiency, reduce disputes, and support investments in modern fleets and multimodal connectivity. This will make the overall supply chain stronger and most effective, cost-effective. Today, I will walk you through how these changes impact transport and logistics sector, both positively in terms of cost saving and competitiveness, and cautiously in terms of new compliance and interpretational challenges. Now, before I jump to the detailed rate comparisons, I want to emphasize that many of you are already familiar with the rate changes under GST 2.0. My reason for devoting a few slides on the rate is not to repeat the number or the change in the rates, but to set a context so that when we are discussing the impact on the industry, we all are aligned on what is changed, where and how much it is changed. Now, taking up the first change which has happened in respect of change in rate on the goods. Earlier, automobiles and parts attracted one of the highest GST slab rates, which is 28% plus cesses in many cases, which has been reduced to now 18%. Under GST 2.0, most mainstream vehicle categories such as two-wheelers, three-wheelers, small cars, buses, trucks, auto parts have been moved to 18% from the earlier 28% plus cesses. If you see delivery agents, rail, ride-hailing services providers rely heavily on two-wheelers, the lower GST rates are going to reduce their purchase cost. Now, only large cars and SUVs are treated differently, where the total tax incidence has been now increased. The tax incidence is now 40%, effectively rationalizing the luxury transaction. Even if you compare the luxury and the SUV cars, The effective rate considering the cesses has been reduced even for those cars under GST 2.0 regime. So if you overall see for the logistic operators, the most direct benefit which has been there is in the reduction in the acquisition cost of the commercial vehicles, buses and trucks from 28% to 18%. Now, once we go to the change in the rate of services pertaining to logistics sector, one of the important change which has been made is to segregate the multimodal transportation in two categories. The first category, what they are defining it as the multimodal transportation of goods, which does not involve any leg by air. So the first category of transportation.
Within 1 minute, I will just request all the participants not to unmute themselves. We have done that setting from our side, but I don't know on account of what technical glitch you guys are able to unmute. But in the deliberation, please ensure that mics are muted. Thank you so much. Preeti, ma'am, please continue.
Yeah, thank you, Shravan. So under GST 2.0, what they have done is they have categorized the multimodal transportation into two categories. The first category, what they are defining it as the transportation, multimodal transportation of goods, which does not involve any leg by air, wherein they have reduced the GST rate from the current 12%, which is with ITC, to 5%. But again, that 5% has the option, like the 5% is with ITC, but that ITC is only restricted to the 5% of the value of inward supply of goods transportation. So if a multimodal transporter is undertaking a particular transaction which does not involve any leg, he will be subject to 5% GST on the outward supplies. Further, whatever inward supplies of goods transportation, for example, if he's availing an GTS services or a container freight transportation services, and if the other vendor is charging 18%, he won't be able to claim the entire credit. The credit will be restricted only to 5% of the value of goods transportation. So that is the restriction which has been placed, wherein the other category is the multimodal transportation involving air-led, which has been moved from 12% with ITC to 18% with ITC. The 5% rate for non-air multimodal transport gives a price advantage, but restricted ITC, which may lead to increase in cost. For large logistic players, this means a careful choice is required to be made whether to opt for 5% concessional rate vis-a-vis the 18% with ITC, depending on their cost structure. Now, the other change which has been made is with respect to the goods transportation agency, wherein the current option of 5% without ITC is continued. The second option of 12% ITC, 12% GST with ITC has been increased to 18% with ITC. The passenger transportation again has seen a dual option of 5% with restricted ITC or 18% with full ITC. The other benefit which has been extended is reduction in GST rate of third-party insurance for goods carriage, which has been reduced from 12% to 5%, which is a welcome relief as it will reduce the total logistic cost of the industry. The next rate of changes pertains to renting of goods carriage, which was earlier at 12% with ITC. Now they have given two options of 5% concessional rate only with ITC on the same line of business, or 18% with full ITC. The new change which they have introduced in the GST 2.0 reform is pertaining to taxing the transaction of local delivery services through e-commerce operator, which are now being notified under Section 9, Subsection 5 of the CGST Act, which means that all the e-commerce operator like Swiggy, Zomato, Blinkit, etc. will now be liable to pay GST on the delivery charges which they are collecting. The likely reaction of this platform is either they will absorb the part of the tax burden, pass it on to the customers, or reduce the delivery partners' margins. Now, most of you will have heard around November or December 2023, DGGI has already issued demand notices of more than 750 crores on e-commerce operators, and alleging that the delivery charges which they have collected are subject to GST and they are liable to pay tax on that. The companies have contested these notices, arguing that the delivery charges are merely a pass-through to the delivery partners, and it's not their own revenue, and therefore they're not liable to pay any GST. Now, one of the questions which comes up is, since the government has recently notified these services, does it strengthen the position of the e-commerce operator to argue that they were not liable to pay GST for the past period? Further, one of the interesting read which I would like to everyone to read also the fair notification which has been issued with respect to this particular category of service. What they're mentioning is that the e-commerce operator will be liable to pay GST only in case if the supplier is not liable to register. It doesn't say that the e-commerce operator is liable to pay GST on delivery charges if the supplier is unregistered, which indicates that if a delivery partner is liable to register, but he doesn't opt for the registration, does it mean that e-commerce operator is not liable to pay GST on those delivery fees? That's a question. And if you technically interpret it, if the delivery partner is liable to register, he doesn't opt the registration, obviously e-commerce operator needs to evaluate whether still they are liable to pay GST. But if you see one of the FAQs which was issued by the government at the time of this rate rationalization, in one of the questions they have mentioned that who is liable to pay GST on local delivery charges. Therein they have said that if the supplier is registered, the supplier will pay GST. But if the supplier is unregistered, the e-commerce operator is liable to pay GST on the delivery fees. So again, that question comes up whether you rely on the FAQs which are issued by the government, or you strictly go with the notification which has been issued. So obviously, if one has to argue, we will rely more on the notification which has a legal binding compared to the FAQs which has been issued. But again, it opens a area of litigation with the department. Leasing of vehicles, ideally there is no rate change in rate, but since in case of leasing of vehicles without operator, the rate currently is based on the rate applicable to the vehicle. So indirectly, since the leasing services were taxed based on the rate of the goods, even the leasing services of the vehicles have reduced since the original rate on the product has decreased. Now, the other and most important amendment which was proposed in the GST Council meeting is one of the most important and contentious issue of the logistic industry or any other industry, which is with respect to the place of supply for intermediary services. Now, under the present law, under Section 13, subsection 8, Clause B of the IGST Act, the place of supply for intermediary services is the location of the supplier. So in simple terms, say if an Indian logistic company provides services to a foreign client, but is treated as an intermediary, the GST is payable in India by the logistic company, even though the customer is based outside India, and he gets the consideration in foreign currency. Now, this has been a major source of disputes even prior to the GST regime. Industry has always been representing to the government to treat it as exports because the recipient is located abroad and the consideration is received in foreign exchange. However, the government has not made any changes. Plus, even the support services which have been provided by the taxpayers or the industry guys, which falls even under the general rule of 13.2 or under the erstwhile laws, they have been arguing that these are intermediary services and should be taxed in India. Now, let's take some examples which the logistic or the transport companies could provide to the foreign entities where they have been paying taxes or where they have taken the benefits of export. One of the activities, sourcing services, many Indian logistic providers help foreign companies to source local transporters, vendors, or carriers in India. Until now, this transaction was taxed in India. Since it becomes intermediary, going forward with a new rule being notified, the place of supply will shift to outside India, where is the recipient is located. So the transport or the logistic company providing this kind of services can claim the benefit of export of services. Now, the second category of services relating to back office or support services, we have seen a lot of judgments, even the circulars which has been issued by CPEC to inform the or field officers to distinguish between the services which are support services that get covered under the general rule of recipient base vis-a-vis the intermediary services, which gets taxed in India. But practically, we all would have seen that any services which the Indian entity provide to a foreign entity, which are back office support services, the department tries to get those things get covered under the intermediary tax transaction. So, for example, if an Indian company is providing shipment tracking, documentation, accounting, invoicing to a foreign shipping company, the department has taken a position that these are intermediate, you should pay GST. Even though these were currently also taxed under general rule, so not taxed, under the general, they were covered under general rule and the exports benefit were available. We have seen cases where the department has taken other stand. Now, with the amendment which will be brought in once the act is amended and notified, these disputes are going to get reduced and the companies are going to get benefited by this provision. The other category of services, which could be the agency services to foreign shipping lines. For example, the Indian agents are working for foreign shipping lines, collecting freight, providing local assistance where they are charging to the foreign entity and they are paying GST as intermediary. With the reforms being introduced, this will get shifted to the location of the recipient and the companies or the agents in India can take the benefit of exports. So if you see an overall basis, the Indian logistic service providers will no longer have to pay GST on such services once it is notified. They will be able to claim the benefit of export of services, and if they have a sufficient ITC balance, they can go for refund also. Further, this is going to eliminate the tax burden, since in most cases what happens practically, the logistic service provider bears the burden of GST. The foreign companies do not reimburse the tax amount. So this is going to reduce the litigation, and most importantly, this is going to improve India's competitiveness in global supply chain. Further, the industry, since we have discussed, it's a long-standing demand being finally met. The shift from the supplier location, the shift of place of supply from supplier location to recipient location, it is going to be in line with global best practices. Whilst we are aware that the rates have been changed and to determine the particular rate of tax applicable, one has to analyze the nature of supply of goods or services, the HSN, and then the question which rate will be applicable. Once the HSN classification is done, the other question comes up is what is the time of supply? Now, specifically in case of change in rate of tax, there is a specific provision laid down under the CGST Act, which is Section 14 of the CGST Act, which says that in case of change in rate, you will have to see the three events which are important in a particular transaction, which will be issue of invoice, the date of provision of supply, or the date of receipt of payment. And if any of the two of the three events falls prior to the rate change, the old rate will apply. But if any two events happens after the rate change, the new rate will apply. That's the crux of the provision. Now, depending upon the events which fall prior to GST rate change, you have to decide whether your transaction will be subject to old rate or new rate. So, for example, if a supply and the invoice is raised prior to 22nd September, the old rate will apply. If the invoice and supply happens after 22nd September, but payment was received prior to 22nd September, the new rate will apply. So the takeaway is that the compliance discipline is crucial during this transaction. Companies must realign their billing, advances, invoicing, payment cycles to avoid any accidental under or over taxation. Now let's see some key issues which one may face while deciding or while analyzing this provision of the critical events which are given under the provision. For instance, if we consider the first example of the transaction where goods are involved, goods have been removed before the rate changed, but received by the recipient after the rate change. So what should be considered as the date of supply? Now, for example, if the goods have been dispatched by the supplier on 20 September, but the customer receives it on 22nd September, so which rate should apply? In my view, the date of removal governs the provision, as the supplier cannot issue or remove the goods without issuance of invoice. And even under a regular scenario, the department considers that when the goods are being removed, you have to issue a invoice. Therefore, the old rate should apply. However, this logic may not be applicable in every scenario because one has to see the contract, whether transaction is a continuous supply of goods. So based on that, the industry needs to see how the transaction gets covered under the change of rate and section 14. Practically, it may happen that if the goods are being received by the customers after the rate change, they will argue that they should get the benefit of the new rates, and this is going to lead disputes with respect to credit notes and reconciliation challenges. The second one is, in case of services, how do you decide what is the date of provision or completion of services? Because it isn't, you cannot see the physical movement of the services. So in case of services, the challenge is determining when exactly the service is provided or completed. Again, we can rely on circular number 144 of 13/2011, which was issued under the service tax regime. To clarify the test for determining completion of service, if you go to the circular, it clarifies that completion of service under the point of taxation rules and service tax rules not only include the physical performance of the service, but also the other related auxiliary services such as measurement, testing, etc., which enables the supplier to raise the invoice. And it should not be a physical accomplishment which can decide the completion of services. So in light of the circular, which was issued under the service tax regime, one has to decide when you can say the services was completed, whether before the rate change or after the rate change. The next one is, again, when we are deciding the three events, one of the important event is what is the date of payment. Now, if you see the definition of date of payment under the GST regime, it has been defined as the date on which the payment is entered in the books of the supplier, or it is credited to the bank account of the supplier, whichever is earlier. And the definition of date of payment is similar to what was defined under the erstwhile service tax regime. Now, if you are aware, there was again one circular which was issued under the erstwhile service tax regime, circular 155/6/2012, at the time when the service tax rates were increased from 10.3% to 12.36%. Now, when the rate of service tax was changed from 10.3 to 12.36, the aviation sector specifically encountered a significant compliance dilemma. The key question was, what is the date of payment of tickets in respect of tickets which were booked prior to the rate change, but travel is after the rate change? Because what happens in an aviation industry, the tickets are booked through agents. So how will you consider what is the date of payment? So airlines, in an attempt to preempt any future dispute with the tax authorities, started levying additional tax at the airport counters from the passengers who had booked the tickets prior to 1st April, but were traveling thereafter. So this led to avoidable confusion and dissatisfaction among the passengers, while also creating reputational concerns for the industry. The government issued Circular 155 to clarify that in the context of an airline, getting the government acknowledged the principal agent relationship, where the ITA agents, general sales agent, and other intermediaries which act as a duly authorized agent of the airline. It held that any payment collected by these agents is legally deemed to be payment received by the airline on the very date of such collection. So it is not the date when actually the agent remits the money to the airline. It is the date when the agent got the money from the passenger will be considered as the date of payment of collection by the airline. Which means the tickets which were the tickets which were booked prior to April 2012 attracted the service tax of the old rate, even though the travel happened after 1st April. Conversely, payments received after 1st April were liable to be enhanced if the travel is happening after, or if the booking is happening after 1st April. So this clarification provided much needed certainty to the airline sector and avoided the disputes for both passengers and the tax administration. It also reconfirmed the relationship of a principal and agent in an aviation industry or even any other industry. So This circular was rightly welcomed and it aligned the compliance framework with commercial practices in the aviation industry, where ticketing is typically channeled through multiple intermediaries. Now, one can also rely on the transport industry, as there are a lot of agents which are involved in even in the transport and logistic industry apart from the aviation industry. And I think one can put a reliance on this, where you can substantiate that the relationship is a principal agent relationship, and the circular will be really helpful while taking a position. The next question which comes up is with respect to rate of tax if a credit note is issued after 22nd September 2025 in respect of supply which is completed prior to the rate change. Now, if you issue a credit note for an old supply, the applicable rate remains the old rate because you're not making a new fresh supply. It's an old supply for which you are issuing the credit note. So the old rate will be applicable for the supplies which have been done prior to the rate change. So if you see when we are deciding the rate of tax based on various events, the critical aspect is the documentation. So your contracts, your invoices, your payment records must be watertight to defend your position with respect to the rate which you're adopting for the transitional transactions. Looking at the overall impact of GST 2.0 on the transport and logistic sector, the major change which has been beneficial for the industry is the reduction in the vehicle cost, which has been reduced from 28% to 18%. The acquisition cost of the assets have dropped sharply. Even the manufacturer, including many leading OEMs, have announced discounts, passing on the benefits to the customers. This makes the fleet renewal and expansion more affordable, especially for small operators. The second important change is the operating and the maintenance cost. The tires, batteries, engines have now been taxed at 18%. The third-party insurance have been reduced to 5%, which is bringing down the recurring cost of the industry. This is a major long-term relief since maintenance eats up a large chunk of the costing for a transporter. Now, the third question comes up with respect to price pass-through. Now, will the transporters and logistic companies pass the benefits or cost savings to the customers? We have already seen that some of the freight codes where the prices have been reduced for MSMEs and smaller fleet owners. This could be an opportunity wherein they can lower the rates to win the contracts while still enjoying the benefit of margins due to reduced capital cost and the running cost. But one has to analyze their business model and their current procurements. The other issue is with respect to goods transportation services, where the rate have been increased to 18%, which creates a challenge from the recipient perspective. As you are aware, many of the goods have been classified under the 5% bracket. So the recipients are going to face inverted duty structure, wherein their outward supply are taxed lower compared to their inward supply, which could lead to refund blockage and working capital lock-in for recipients. What is going to happen is the recipients are going to create pressure on the logistics service providers to reduce the pricing. Similarly, on the passenger side, the cost may rise because some of the GST rates for certain passenger transportation options have been increased to 18%. With respect to multimodal transport without air, which does not involve any air leg, now attracts 5%. So while this sounds attractive, but it comes with a caveat that ITC is a restricted ITC. So the lower rate with a price edge, but leads to ITC blockage and increase in cost. So one has to analyze which of the, obviously the multimodal, you don't have any option, but you have to go for the 5% where there's no air leg involved. This puts an additional burden with respect to maintaining the documentation, because you have to prove whether a particular multimodal transportation involves an air leg or does not involve an air leg. Because the rate is different, the ITC eligibility is different. The last impact which I could see is with respect to the classification of mismatches, in the sense many logistic chains involve subcontractors. For example, a multimodal operator may appoint a GTA who is billing them at 18% rate with ITC, whereas the principal operator has to pay GST of 5%, which is going to increase the cost in the hands of the multimodal transporter. Now, the other key challenges which the transport and logistic industry are going to face is with respect to the input tax credit computation. While some reforms have given a choice to adopt a concessional rate with limited ITC or go for 18% with ITC, some options are mandatory to be implemented with lower ITC. Now, while this looks simpler that we will go with the lower rate and will forgo ITC, one has to see what impact it is going to have on the ITC which is claimed during this current financial year. Now, for example, from 22nd September onwards, the government implemented clear ITC instruction for concessional rates. That means if you opt for 5%, say multimodal or passenger, if you are getting covered under 5% multimodal transport activity, many credits like subcontracted services, warehousing, even common administrative cost will not be allowed. So what is going to happen on the ITC on supplies which were already available before 21st September? Whether those credits are safe and they do not need any reversal. So that has to be analyzed, and it is going to add to the challenges which are to be addressed by the government. The other complexity arises where the supplies have been procured before the rate change, but they are going to get utilized after the rate change. For instance, if you have paid the amount relating to office rents, software, but these are related to over a period of week, but the expenses are related to the period which is after the rate change. So what is going to happen? Are you going to reverse the credit as per Rule 42? Or you will say this, since the procurement is prior to rate change, there is no question of reversal. According to me, one has to analyze the procurements. If the use of inward supplies can be directly attributed to the outward supplies, which were not subject to any restriction, even though the ITC is claimed after 22nd September, there should not be any reversals. But if any common ITC has been availed even prior to 21st September on inward supply of services, which is for the period on or after 22nd September, the common credit should be ideally recomputed. But that is a position which will differ based on the facts of the case. And the other issue, whilst we have to decide the nexus of the input vis-a-vis output, the other question is, even if you go for reversal under Rule 42 or 43, it is based on the turnover of a particular financial year. So what are you going to consider as a turnover? Are you going to consider the entire financial year, or you are going to only consider period beginning from 22nd September, because up to 21st September, all the supplies were eligible supplies and you have claimed the credit? That becomes a question. So some planning has to be done to compute what is the immediate tax outflow, what are the benefits of the ITC which the company is going to get. If there are options are available for going the lower rate with reduction in ITC or a higher rate with ITC, one has to carefully done the planning before opting for any option. Now, some of the commercial and compliance actions which, according to me, the industry needs to take is with respect to the contracts, existing contracts and the tenders. Many logistic companies work on long-term contracts, whether with corporates, PSUs, or government departments. If those contracts were signed prior to 22nd September, they might not have clauses along GST rate adjustments. This is going to create risk of mismatched tax incidents. You might have to pay high rate of GST while the contract price assumed a lower rate of GST. So one has to review the ongoing contracts and renegotiate the terms of the rates wherever possible. For all the new contracts, obviously, I think you will have to see how you can incorporate the GST rate change clauses to avoid any future disputes. The other could be the government tenders, wherein mostly in some government tenders, they may insist on an all-inclusive tax rate, but they don't allow any change in the rate. So one has to check if there's any scope of approaching the tender authorities of highlighting the rate change which has happened pursuant to the GST 2.0 reform, and whether there's any scope of increasing that pricing in the transaction. The other action is with respect to the upgrading the accounting and systems, accounting ERP or CRS systems. Now, For instance, the airlines are using the computer reservation system for their global bookings. So pursuant to the change in rate of tax on premium and business class tickets from 12% to 18%, they would have already done the updation in their CRS system for the increase in rate. Similarly, the logistic industry has to update their freight quotation modules to reflect the new rates, whether they are 5% or 18%. The HSN masters are to be updated. If the systems are designed to extract the details for filing purposes, that is 3B e-invoicing, those are to be reconfigured to ensure the proper reporting. The reconciliation modules must account for ITC restrictions if there are any ITC conditions have been laid down under the new reforms. The other one is team also has to carefully monitor the ITC which will be blocked pursuant to the reforms or which they will be eligible to claim it. So that ITC tracking is a must exercise which one has to do. The next one is the invoice and documentation. Now, obviously, since there is a change in rates, one has to ensure that your invoices must be clearly showing the new rates which are applicable in respect of time of supply, which is on or after 22nd September 2025. Even for multimodal contracts, evidence like your airway bills of ladings must be kept to prove whether your transaction is subject to 5% or 18%, or whether you are eligible for ITC or you're not eligible for ITC. The other one is communication with the customers or the vendors. That's an important activity which every industry should undertake whenever there's a change in tax rates, to update your customers and vendors and to ensure that there are no future disputes which may arise at the time of invoicing or a supply. Therefore, I would recommend that short trade circular or an email should be sent to clients or the vendors to avoid any future disputes. Now, as we all know that there have been a lot of discussions which have been happening that the Indian economy is going to grow because of this GST rate rationalization. The consumption is going to get increased, and according to me, also there are a lot of opportunities which the logistic players will be exploring. I'm 100% sure for that. For instance, they must be exploring if there is an opportunity for fleet expansion and renewal. Since the GST rate on trucks, commercial vehicles, auto parts have reduced from 28 to 18%, the capex burden falls sharply on that. For example, even a 40 lakh truck, wherein the tax rate has been reduced from 28 to 18, will lead to 4 lakh savings of GST. Even the manufacturers are already offering discounts, passing on the benefits, making easier for the transporters to modernize their fleets and reduce the maintenance cost. In turn, this is going to improve the service quality and the competitiveness of the players in the industry. The other point which needs to be explored is the competitive pricing advantage. With the cost falling, logistic companies can pass part of the benefit to the customers, positioning themselves as cost efficient partners. For MSMEs and smaller players, this is a golden opportunity to win the contracts against bigger players by offering better rates. Large 3PLs, on the other hand, can pass through savings selectively, using them as a negotiation tool with key clients. The other one is the multimodal transport expansion. The concessional 5% rate for non-air multimodal transport creates a strong incentive to move towards the integrated logistic chain. Rail, road, sea combinations can now be picked up more attractively compared to pure road transport. And I guess this is going to support the national logistic policy vision of the government of shifting the freight to multimodal networks. For logistic companies, this is an opportunity to build end-to-end multimodal offerings, differentiate themselves, and tap into the government's infra push on the dedicated freight corridors, waterways, and multimodal hubs. So, if I have to summarize the GST for the transport and logistics or for any sector, I would say it's not just a tax reform, but it's a business reform. It lowers the cost, open new opportunities, and rewards those who are ready to formalize and modernize. Any questions, I'll be happy to take it. Hello.
Uh,
Shravan, any questions from the participants?
Ma'am, there has been no question specifically, except Shravan has its own question to say on the whether we expect the amendment on the intermediary to be a retrospective or a prospective provision.
No, I think it will be prospective amendment. There's no intent of giving any retrospective benefit to the industry.
Because that would also, whether section 11 on as is where is basis would be
Maybe that's a different discussion which the government may take up for a particular industry. But as of now, if we see any discussions or council meeting agenda or the minutes, I don't think there's any discussion happening on giving a retrospective benefit for the past period.
okay.
No, because the question why I'm asking, because where there are ongoing litigations in respect of intermediaries, and what I'm being told by officers is that like how we have got circulars in past, wherein what treatment taken by the companies in past to be taken into consideration is expected. But I don't see anywhere, because that is why they are not passing any order, negative or positive, because that's the reason, and they're not relying on this amendment also. So they are telling there may be such things coming up. So I just wanted to know if there is something for the past periods also to get to close the litigations period, because my zero rated are being questioned only on this intermediary definition. That's why.
Yeah, I understand, Sharon, but I think it is going to impact if this benefit is going to be given to any particular industry. If you see, there are a lot of companies in India who are providing support or back office support services to foreign entities. And ideally, if you see the demands which the department is raising currently, technically it is not sustainable itself. So all the services which they have been disputing that it is back office should be created as intermediary, should be dropped on merits instead of being waiting for the council to give a retrospective amendment, because even though if the retrospective amendment is given, if one has to ask me, the back office support services doesn't get covered under intermediary services. Only pure agency services gets covered. And I don't see a retrospective exemption until unless a particular industry is going to represent before the authorities and everybody has taken a similar stand in a particular industry.
Why I'm speaking on this, because this is particularly for a freight forwarder client. So what has happened, the basis intermediary and agent, the exemptions of air import, air export and air exports were questioned. So at ASMT 1011, we were able to convince him to the fact that exemptions is very much allowed, and he has denied it. He has accepted it. Now for the fact, same point on intermediary has question zero rated. So he's telling I'll wait for something from government to happen for this, then only I'll be passing things forward. So I told, why can't you apply the same logic of exemption? You have given exemption by stating that we are acting as a principal, then why can't the same flow into zero rated also? But he wants something from government. That's why I wanted to just understand.
Yeah, I think these are to be also legally handled, because most of the officers expect the taxpayers or the business holders to get clarification from the department, from the government on every issue, which is not practically feasible. And one has to
Fine.
see how we need to make our submissions and ensure that we get the decision what we are actually expecting. So it's not feasible for any taxpayer or the business person to take clarification from the government on each and every aspect.
Okay, fine, noted. Again, Tapas sir has mentioned circular of 2021 is there. But the department wants something from GST. That's why. But again, see, I was told that there are similar circular being expected to come from freight forwarding to give a clarity in GST. But after this intermediate definition, do you think it will still come, or that is no requirement?
Sorry.
So there was a circular in Service Tax 2021, which focused on which freight forwarder is acting as an agent and which is acting as a principal. And they defined the place of supply at that point of time, place of performance of service. So there were some discussions going with Freight Forwarders Association. They mentioned that similar circular they are expecting in GST also to come, and they are pushing to council. So now, because of this intermediary definition coming into picture, do you think that particular circular will be coming down the line, or we can
I think if the circular is generally issued to clarify the position on a particular date, and if they want to clarify the position which a particular industry has been following till date, I think they may come up with a circular to clarify the past period to decide whether the services are getting covered under intermediary or not. Okay.
Okay.
It doesn't mean that the act will give a retrospective benefit to them. That may be a clarification which can be issued for a past period.
Noted. Noted.
And it's not like that once the amendment is issued, until unless the government specifically mentions that a particular amendment has a retrospective effect, the even department or even as a taxpayer, we cannot rely on that amendment to say that it has a retrospective effect.
Got it. Got it. Over to you, Nishant. I think there is one more question. If Nishant sir is not available. So it is there in the chat box. In our case, we are buying a bus and availing ITC, and our business model is renting of buses to bus operators to Red Bus. Now the question is, we are availing ITC, but one of the customer has asked us not to avail ITC if he is paying RCM for 5%. When I can avail ITC for one customer and open for open customer, if I go 5%, is it acceptable subject to reversal of ITC under 42 or 43? Please clarify.
So according to me, one cannot opt for this option recipient wise. It has to be as a taxpayer himself. He cannot say that I will opt for this option for one particular recipient. I will go for the entire rate for the other customer. If one has to opt for a particular rate structure, it has to be at the GSTN level, not at the recipient level.
Got it. Any, I think these are the questions which have been raised. Any other questions if members wants to post before we start the next session? Next session by Arpit Haldia. I assume there are no questions, Preeti, then. Thank you so much, Preeti, for your T20 series deliberation on covering this particular GST 2.0, specifically on logistics and freight forwarding sector. It was insightful the way you have captured the industry focus. So thank you so much for the deliberations. I will now
Thank you.
request.
So I would also like to thank CGPI and Maharashtra Chamber of Commerce for organizing this series and all of the participants for their time and participation. I hope the insights today will help you to navigate through the GST 2.0 reforms with confidence. Thank you so much.
Thank you. So I will request Nishant sir to have a formal introduction to a very well-known person in the era of GST.
Good evening, everyone. And it's an honor to introduce Arpit Haldia, sir. He's, he's a chartered accountant, he's an advocate, as well as he is a PhD holder uh, in indirect taxes. He's been authored 9 books with 34 editions in total on GST only. I'm appalled, frankly speaking, to know much more about this. And he's been a speaker since 2007, and he has taken various seminars and conferences in study circles, meetings, everything on all subjects, including GST, VAT, and direct taxes. He has been a regular faculty at NASIN, and he has been office bearers on various forums, including Tax Bar Association Jodhpur, the CIRC of ICI, and to give you a brief about, he has a follower of more than 40,000 on Twitter. So you know whom to follow now for more updates on GST. And frankly, I have been following him since long time. And every time you just wake up in the morning and you need to read Arpit Haldia sir's tweet or his message on LinkedIn. And you probably would be you get a new insight on a specific section you never thought in a way I have read it before. Thank you, Arpit sir, and we give you the charge. Please take over please continue the session. Thank you.
And thank you, Nishanji, for such a wonderful introduction. And I was really surprised and how you introduced me. And thank you, Shravan, and thank you, CGPI, for giving me this opportunity. This is my first time I'm taking session on the platform of CGPI. So it's an honor to be coming on the platform of CGPI for giving a session on GST 2.0 and hospitality industry. And as Preeti ma'am has already taken on the transportation logistics, so I congratulate you also, ma'am, for such an insightful session on the transportation logistic industry and discussing about one of the major impacts on multimodal transportation, which has taken place in GST 2.0. So
Thank you,
starting with
Arpit.
the
Thank you.
So starting with today's session, and I have been given specific of about the hospitality industry. So before going on to the hospitality industry, just a brief about how the rate schedule looks like post GST 2.0. And what I have found is something very interesting on the part of how the rate schedule for goods, not for services, but for goods, how the rate schedule looks like. And if we go through the custom manual 2000, I'm going just beyond my topic, but it's an interesting observation. So if we go by custom manuals 2023 and chapter 4 para 2.1, it says that how the goods schedule has been made to look like in tariff. So it starts with an increasing degree of manufacture of commodities or products in the sequence of natural products like the food products, then the raw materials, semi-finished goods and fully finished goods or articles that is coming in chapter 84, 85 and 86 and 87. So that is how we see that first there is the goods, there the chapter heading for food and food related articles, then it comes to medicines, and then it comes to paper industry, then it comes to cloth industry, then it comes to iron and steel, and then it comes to the plant and machinery and the motor vehicle part. So this is how the schedule and various chapters have been sequenced in the tariff schedule. And post GST 56 GST Council meeting, what is the big change? Yes, we all know that 12% and 28% have gone. But now out of the 98 schedule, 98 chapters, we can say, now 20 chapters are having only one rate. So if I am able to identify what is my chapter in which I am falling, 20 chapters are such there wherein there is only one rate. So the classification dispute for those 20 chapters would be gone post 56 GST Council meeting, like in chapter 15 for ghee. Now, in chapter 15, now there is only one single rate of 5% in chapter 15. After these 20 chapters, 47 chapters are such wherein there are only two rates. So once I am able to identify out of those 47 chapters I am following, there are only two rates applicable. So if we can see that out of the 98 chapters which are there, 67 chapters are now such where either there is one rate or more than one rate, but up to two rates. So out of roughly 70% chapters are having either one rate or two rates. And only 30 chapters are such wherein there are more than two rates, and one is a reserve schedule, reserve chapter which is there. So it's a very interesting matrix which has taken place post 56 GST Council meeting, wherein out of 98 chapters, 67 chapters are only having one rate or not more than two rates. This was a brief observation going beyond my topic. Now coming to the topic which has been given to me for the hospitality sector. If we go through, there are only three changes which are applicable to the hospitality sector. The first and the foremost is regarding the accommodation, food and beverages, wherein the supply of hotel accommodation having value of supply of a unit of accommodation less than or equal to 7,500 rupees per unit per day of equivalent has now been reduced to 5% without ITC. This is the one single most talked about amendment which has taken place for the hotel accommodation and hospitality sector. Now that the tax rate is 5% without ITC, and what would be the implications that we will discuss going further into the session. The second important amendment which has taken place is regarding the rental services of transport vehicle with operators, as Preeti ma'am already discussed, that there are two options now, 5% and 18%. Previously, there were also two options, but there were 5% and 12%. Now the 12% rate has now gone, so it is now 18%. It has been increased to 18%. And the third is heading 9997. That is for beauty and physical well-being services falling under group 9972, which is again 5% without ITC. Now, these are the broad three changes. So, coming to the changes regarding the beauty and physical well-being services, what are the services which are covered and which would be impacting the hospitality sector? So the spa services, if there are any being provided by the hotels, then now it would be coming with 5% without ITC. Once we give a cursory view, it seems that 9997 rate change would not be impacting the hotel industry. But once we go through the services, I have given the detailed services which are being covered under 9972. Now, if we see the spa services, which is a very important part of a five-star hotel. See, we are not talking about a budget hotel which is having a accommodation service room of say 7,500 below, but we are talking about a five-star hotel which is having a spa services. And on a discussion which I had with the hotel industry and in some of the big hotels, this revenue of spa, it is somewhere between 2 to 3% of the entire revenue. And now would be coming with a condition of 5% without ITC. Why it is significant? Because in cases of hotels which are having all their rooms beyond 7,500, the restaurant services also up to are also chargeable at 18%. This single service would now be falling within the ambit of Rule 4243 reversal. And once it falls within the ambit of Rule 4243 reversal, it would not only be impacting the direct ITC of the capital goods and the raw material which are being used for providing those spa services, this would also be impacting the common ITC which is there. And this would be increasing the cost for them while providing their services. So on the face, we can see that there is a decrease of 13%, but at the same time, the reversal part would be increased, and that reversal part would be increased on the common ITC for the entire hotel. So that would be a big addition to the cost of these services which are being provided. So in 9997, the one service which I could associate with the hotel industry is spa, although there are many other services, because there are beauty treatment services which are being provided in the 9972. Some of the hotels are providing beauty treatment services. So that would also be covered in 5% without ITC slab. So this is the impact of 9972. 9966, Preeti ma'am are already taken, so I would not be going into that. Now coming to the changes in 9963. And 9963, room rent less than 7,500, 5% without ITC. The first question which comes to the mind is applicability of section 17 subsection 2 vis-a-vis applicability of section 18 subsection 4. This discussion, although only related to the hospitality industry, but it's a much wider discussion. When I've tried to encompass both the interpretation of section 18 subsection 4 and section 17 subsection 2. Now, if we go through section 18 subsection 4, the first thing is, supposedly I am running a hotel. Now, once I am running a hotel, say in the state of Rajasthan. Why in the state of Rajasthan? Because it's a seasonal industry here. And when it's a period between April to September, all the rooms are below 7,500 because it is told as the off season. But from the period October to March, all the rooms are generally more than 7,500 because it is the peak season. And the generally booking crosses to the entire occupation of the hotel if the hotel is running the accommodation, providing the accommodation services. So now for the first 6 months of the financial year, all the rooms would be below 7,500. For the next 6 months, all the rooms are generally more than 7,500. So now the question comes that once the rate has been reduced to 5% without ITC, whether section 18 subsection 4 would be applicable or section 17 subsection 2 would be applicable. Now, if we go through section 18 subsection 4, the first part is where any registered person who has availed the credit opts to pay tax under section 10. This is the first option, opts to pay tax under section 10. That means the entire business of the registered person opts for Section 10. It is not a case that I can opt for a Section 10 for one supply and I remain in a normal GST regime for other supply. So the first limb of Section 18 subsection 4 covers the entire supply of the registered person, because he opts for section, when he opts for Section 10, entire supply goes for the composition scheme. The second part is, or where the goods or services are both supplied by him become wholly exempt. Now the question comes is that what is the scope of this term where the goods or services are both supplied by him becomes wholly exempt? Whether it is covering, supposedly I am covering say 3 services, out of which 1 service becomes exempt and 2 still remains taxable. This is the first scenario. The second scenario is I am providing 3 services, all those 3 services becomes exempt. So now this part of Section 18 subsection 4, where the goods or services are both supplied by him becomes wholly exempt. Whether it is applicable for the first scenario, wherein out of the 3 only 1 becomes exempt, or it is only applicable to the second scenario wherein out of the 3 all 3 becomes exempt. That we have to understand from the how the language has been drafted for 18 subsection 4. Now when we go ahead and read the language, it says he shall pay an amount by way of debit in electronic credit ledger or electronic cash ledger equivalent to the credit of input tax in respect of inputs held in stock, inputs contained in semi-finished or finished goods held in stock, and on capital goods reduced by such percentage as may be prescribed. Now this is only speaking about the amount of reversal to be done. When we come to the proviso which is given there in 18 subsection 4, it says provided that after payment of such amount. Now what is the such amount? It is reversal on the goods lying in stock and the capital goods. Who would be making the reversal? First, the person who is opting for Section 10. And second, where the goods or services are both supplied by him. So both these terms are to be read together and have to be given same meaning, because when the proviso says that provided that after payment of such amount, the such amount is covering the entire amount which is first either to be reversed by the person who is opting for composition scheme or by the person whose services have become wholly exempt. Because once he reverse such amount, the balance of ITC, if any, lying in his electronic credit ledger shall lapse. So it says once I reverse the amount, all the balance which is lying in my electronic credit ledger will lapse. So if I am applying this provision to a case wherein one of the services have become exempt, but rest of the 2 services are still taxable, this proviso becomes inoperative. Because they cannot provide that since your one service have become exempt, for rest of the 2, for all your credit will lapse. This would be an absurd interpretation of the proviso and the provision. And this proviso, when we read in context of the person who has opted for Section 10, this makes sense because all the supplies for that person now have come under the ambit of composition scheme. Therefore, since all his supplies would be subjected to composition scheme, the obvious conclusion would be that all his credit, if at all lying and on the date of conversion, shall lapse. So therefore, the similar meaning which is given for Section 10, reading in line with the proviso which is there in 18.4, should also be given to the second limb of this provision, that where the goods or services supplied by him become wholly exempt. Wherein all the services which are being provided by him becomes exempt, not where either one service becomes exempt, but rest of the services are taxable. So in my opinion, 18.4 has no relevance. Firstly, for hotel industry in 9963, why? What would be the another reason that we will discuss going forward when we move on to the second slide. But for a general interpretation, 18.4 is not applicable in my opinion, wherein some of the supplies are taxable and some of the supplies become exempt post 22nd September 2025. Now coming to the second interpretation of 17 subsection 2. wherein it says that where the goods or services of both are used by the registered person partly for effecting taxable supplies, including zero-rated supplies. So, on a partial use for making a taxable supply and partial use for making a exempt supply, section 17 subsection 2 read with 42 is applicable. Now, when I go through rule 42, it says the input tax credit in respect of inputs or input services which attract the provision of subsection 1 or subsection 2 of section 17 being partly used for purpose of business and partly used for other purposes or partly used for effecting taxable supplies, including zero-rated supply, and partly for effecting exempt supplies shall be attributed to the purpose of business of effecting taxable supply in the following manner. What is the manner? It says the total input tax credit involved on input or input services in a tax period is to be denoted. So that means first for rule 42, the first calculation is for a tax period. So supposedly for April 25, I have received some services, I have made some output supplies. My first calculation would only be for April 2025. Similarly, for May 2025, June 2025, July 2025, August 2025. Now, supposedly, let's take a hypothetical example that a hotel owner made some purchases in the month of August 2025 for the accommodation services. At that time in August 2025, all the services in accommodation were taxable either rate of 12% or 18%. So he had claimed the credit of those supplies in the month of August 2025 and used it against the taxable supplies. Now, hypothetically, that inward supplies are lying in stock as on 21st of September 2025. So that now those supplies are lying in stock as on 21st September 2025. Now the question is, when the reversal of rule 42 or reversal of credit in respect of those goods lying in stock as on 21st September 2025 has to be made? Whether it has to be made in the month of September itself or it has to be made subsequently. In my example, I had taken the scenario wherein the purchases were made in the month of August 2025. The credit was also availed in the month of August 2025. The credit was also utilized in the month of August 2025. And when I was making a calculation of rule 42 sub rule 1, I was only required to make a calculation only for the month of August 2025. And since all my inward supplies were being used for making an outward supply, which is taxable in 100% taxable in nature, therefore I was not required to reverse for that tax period. So in my opinion, for the credits which have been claimed in the month of August 2025, even if those goods are lying in stock as on 21st September 2025, no reversal has to be made in the return for the month of September 2025. So if no reversal is required to be made in the month of September 2025, when the reversal would be required to be made? There is no doubt that the goods which are lying in stock as on 22nd September 2025 would be used in making, say, partially exempt supplies and partially taxable supplies going forward, because some of the rooms would be 7,500 and some of the rooms would be more than 7,500. Therein comes the picture of rule 42 sub rule 2. Rule 42 sub rule 2 says, except in case of supply of services which are covered for builder, the input tax credit determined under sub rule 1 shall be calculated finally for the financial year before the due date of furnishing of the return for the month of September following the end of the financial year to which such credit relates in the manner specified in said sub rule. That means when I would be making a calculation for rule 42 sub rule 2 for the entire financial year, then the reversal would be required to be made. But then what would be the due date? It would not be the return for September 2025. it would be September 2026. So in my opinion, 17 subsection 2, read with rule 42 sub rule 1 is only applicable wherein rule 42 sub rule 1 is only applicable wherein the credit has been availed in September 2025 and I am filing the return for September 2025. For the credit availed from April to August 2025, reversal would be required to be made in 17 subsection 2, but that would be as per rule 42 sub rule 2 because then I would be making a calculation for the entire year. This is for a case wherein the goods are being partially being used for making a taxable supply, partially for an exempted supply. Now let's take again a hypothetical scenario that what happens to a case wherein I am making a supply and only one supply is taxable and rest of the two supplies become exempt, and for the supplies which have become exempt from 22nd September 2025, I have an opening stock which is lying from 1st of April 2025. Whether there would be any reversal for 18 subsection 4 or section 17 subsection. In my opinion, since not all my supplies have become exempt, 18.4 would not be applicable. 17.2 read with rule 42 would be applicable, but that would also not be applicable for opening stock because that opening for the credit which was availed pertaining to that opening stock was availed in 2024-25, and when it was availed in 2024-25, all my supplies were taxable, and when I'm making a annual reversal, I am only making it for a particular year in which the credit has been availed, not for the year wherein those goods might have been utilized. So for the goods which are lying as on 1st of April 2025 and the credit was availed prior in the financial year, say 2024-25, 17.2 would not be applicable even though those goods would now be used for making a partial taxable or partial exempt supply. So now 17.2 and 18.4 we have discussed. Now coming to the discussion of that how 17.2 and 18.4 would be applicable and whether at all, the first question is whether section 18 subsection 4 is applicable to hotel industry for reversal of credit since it is the rate which is being provided is 5% without ITC. The rate notification number 11/2017 provides that the rate is 5% without ITC, and then in the next column it says that refer to clause number 4 given in the explanation. And the clause number 4 given in the explanation of notification number 11/2017 says wherever a rate has been prescribed in this notification subject to the condition that credit of input tax charge on goods or services used in supplying the service has not been taken, it shall mean that credit of input tax charge on goods or services used exclusively in supplying such service has not been taken, and credit of input tax charge on goods or services used partly for supplying such service and partly for effecting the other supplies eligible for input tax rate is reversed as if supply of such service is an exempt supply and attracts provision of section 17 subsection 2 of CGST Act and rules made thereunder. So a deeming provision in this condition is only made for 17 subsection 2. It is not made for 18 subsection 4. So there are two reasons why 18 subsection 4 is not applicable to a hotel industry. First, which we have already discussed, that 18.4 is only applicable wherein the goods or services have become wholly exempt, that the entire bouquet of services or bouquet of supplies which have been provided are exempt. Let's take an example that for a hotel, this is a hotel wherein all its supplies have become exempt. But still 18 subsection 4 would not be applicable because the deeming provision in clause 4 is only applicable for 17 subsection 2. It is not extending itself to 18 subsection 4. This is the first analogy of applicability of 18.4 to the hotel industry. The second part. Now, this is one very interesting thing, and it came through a discussion which I was having with one of the members of CGPI only, Ashwin. And this was a discussion which took place between us. But 18.4 is not applicable. Yes, that we have concluded for hotel industry. Now coming to section 17 subsection 2, and in section 17 subsection 2, read with 42, rule 42, generally there is no stock available with the hotel industry. So 17.2 would only be applicable in case of capital goods for a hotel industry. Now let's take an example of capital goods which have been purchased. Supposedly a hotel industry, I have given a figure here in my presentation. Supposedly a hotel has purchased certain capital goods in August 2023, wherein the credit was 60,000 rupees. They have availed the credit of those capital goods. They have utilized it against their output supplies in August 2023. And since for a hotel at that time, entire supplies were taxable, so no issues with the reversal part. In August 2024, also they purchased 1 lakh 20, they purchased capital goods which are having credit of say 1,20,000 rupees. That also was used and utilized in payment of tax. No question of reversal. But post 22nd September 2025, those capital goods are still there in the balance sheet. Now that hotel would be providing some exempt services and some taxable services going forward post 22nd September 2025. Now the capital goods are there. The life, as we all know, is 60 months for those capital goods, and 60 months have not expired for those capital goods which were purchased in August 2023 and August 2024. So a natural understanding would be that supposedly these are the only two capital goods which I have purchased. So while I would be filing my return for say September 2025, there would be a common credit of 3,000 rupees for capital goods in the month of September 2025, which would be required to be reversed in the proportion of exempt and taxable supplies. And similarly, going forward for October 2025, November 2025, December 2025. So this is an additional cost which is now there for the hotels, which are primarily having a range of less than 7,500. An interesting data which was shared in one of the sessions which I have taken along with the department authorities for the state of Rajasthan only, wherein 85% of the hotels in Rajasthan who were registered in GST regime are having a tariff, are having a room rate of less than 7,500 for the entire year. So there are many small hotels. Yes, there are big hotels. So majority part of the small hotels would be giving a room rent of say less than 7,500. Now for the assets which had purchased earlier, they would now be required to reverse the capital goods credit starting from September 2025, because all their rooms or partially their rooms would be less than 7,500. So this is one understanding of reversal of capital, reversal of credit pertaining to capital goods, and impact of condition number 4 in the explanation to notification number 11/2017. This is the literal reading and this is the general interpretation. There is another line of interpretation. Why I am discussing this? Because when we are faced with the litigation, we are not talking about at the compliance stage, but when we are faced with the litigation stage, we don't have any other option but to litigate. So we become adventurous and we take grounds which we normally do not advise at the time of compliance, and sometimes they do click also. So when I go through condition number 4, it uses the term goods or services. But when I go through the notification which is there, goods and services, the condition which is there along with 5% rate, goods and services has been used 3 times, where goods and services has been used. Goods and services used has been used 15 times. Goods or services was used only 1 time. That is also in 9964, which was also substituted from or to and by notification number 31/2017, central tax dated 13th October 2017. In respect of goods, wherein credit of services not debarred has been used 2 times, and charged on goods, wherein credit on services not debarred has been used 6 times. So if we go through the rate notification, goods or services has not been used. Only phrase which has been used is goods and services, or goods or services was used 1 time, which has now also been changed to goods and services. So there is one school of thought which as I said, that came from Ashwin when we were discussing this part, that since the rate notification uses the term goods and services, and the condition number 4 uses the term goods or services, therefore this restriction of para number 4 is not applicable for the capital goods which are there in the balance sheet as on 22nd September 2017. Yes, for the capital goods which have been purchased subsequently to 22nd September 2017, credit would not be allowed for them, but for the capital goods which are lying as on 21st September, this condition is not applicable, and therefore the credit is not required to be reversed. This is one school of thought just shared for the purpose of having a discussion between the members. There is another interpretation of section 18 subsection 4. Now this is also not relating to hospitality industry, but since we have discussed 18 subsection 4, so therefore I am discussing it, that 18 subsection 4 uses the term wholly exempt. Now what is the scope of the term wholly exempt? Because if we go through the rate notification for compensation cess, the compensation cess on the goods like say motor vehicles or say aerated drinks, because aerated drinks sometimes form part of the hospitality industry also, they have become nil rated. Now the question is, what happens to the ITC which is lying with them for the goods which are purchased from 1st April 25 to 31st of August 2025? And supposedly not for hospital industry, supposedly I am a dealer only in aerated drinks. Now my entire stock which is lying there as on 21st of September 2025 has become wholly exempt. Has become nil rated in for compensation cess. So whether the term of nil rated would also be covered in wholly exempt? Yes, one school of thought says that yes, since it is nil rated and the entire stock which was being supplied now becomes say nil rated from compensation cess, therefore compensation cess not only which is lying in balance, but for the stock which is there has to be reversed. There is another school of thought which is coming from the definition of exempt supply, which is there in section 2 clause 47. Which says that exempt supply means supply of any goods or services or both which attracts nil rate of tax or which may be wholly exempt from tax under section 11. So a nil rate of tax is different from wholly exempt from tax under section 11. And since section 18 subsection 4 uses the terminology wholly exempt from tax, and the compensation rate notification has only made the goods nil rated. Therefore, even if I am only supplying goods, say A-rated drinks, on which there were compensation cess, and I had paid that compensation cess at the time of purchase. Now, since no longer compensation cess is there, still I would not be covered under section 18 subsection 4. This is another school of thought which is there. And since we are into an advanced discussion about impact of GST 2.0, therefore I have thought that it's better to put forward this view also before the members, and this view of wholly exempt differentiation between a wholly exempt and nil rated. This also came through a discussion which I was having with another member, Achal Kapoor ma'am. This was her view, and I thought that this view has also to be shared with the members, because when we come through on the platform like CGPI, it's good that we discuss the provision threadbare and the entire gamut, that how the provision can be interpreted, because when we are interpreting a provision, we never know that what interpretation might click on going at the litigation stage. So this is also one of the interpretation of section 18 subsection 4. Although when we read the term of wholly exempt vis-a-vis how it has been used in section 23, persons not liable for registration, and in 23(1)(a), it says the following person shall not be liable to registration, namely any person engaged exclusively in the business of supplying goods or services, or both, that are not liable to tax or wholly exempt from tax under this act. So when we read 23(1)(a), we generally treat that wholly exempt would also include nil rated, because if that interpretation is not taken from 23(1)(a), then in such case, even though the goods are nil rated, say for compensation says, if the turnover exceeds 20 lakh rupees, a separate registration would also be required. So this is a complete understanding that how the term wholly exempt has been used in the definition of exempt supply and in section 23. Now it's up to the members that how they interpret and come to a conclusion. Now coming to the other impact on hotel industry, this was section 17(2) and 18 subsection 4, and this is one thing which would be going to be litigated post GST 2.0. See, this is not the first time wherein certain goods or services have become exempt from tax. But this issue has now been highlighted in such a manner that now it has come to the litigation that how 18(4) has to be interpreted or section 17(2) has to be interpreted. Now, litigation for tax rate in hotel industry. The first litigation which might come up is hotel industry for rooms up to 7,500. What happens to extra bed? Whether this extra bed would be part of the value of supply mandatorily, or it has to be seen on a case-to-case basis. So let's take an example that I am going to a website of hotel and I book a hotel wherein there are two options, whether you want to book a room or along with the room you want to book an extra bed. So in the first case, I only book a room, say that is for 6,500. When I go to the hotel, at that point, I book a extra bed, which is for say 2,000 rupees. So now 6,500 plus 2,000 rupees. This is the first scenario. The second scenario is while I am booking the room, I select both the options, room also and extra bed also. So now at the time of booking, I have booked both the options and my booking amount is 8,500. So how the tax rate has to be applied? So in the second scenario, there is no doubt that it would be at 18% because the value of supply is more than 7,500, and since it's a composite supply, so 18% tax rate would be applicable. But what happens in the first scenario? Whether the tax rate on the room would be 5% since the value of the room is 6,500, and the services which were booked post booking of the room are an independent supply and therefore they would be taxable at the rate of 18% separately, or since value of extra bed is an indispensable part of the room accommodation, even if it has been booked separately, the value has to be seen as 8,500, and irrespective of the fact that when extra bed was booked, it would be chargeable at the rate of 18% for the entire 8,500. This we have to see in light of the circular which was issued by the government for the cases of warranty, in my opinion, wherein they said that if the warranty is booked along with the booking of the vehicle, it is a composite supply. But if the warranty is booked after the supply of vehicle, then it becomes an independent supply. So in my opinion, if the extra bed is opted subsequent to the booking of the room, I have only opted for a room only booking and at 6,500, so it would be applicable at the rate of 5%. And if I have opted for extra bed separately at the time of hotel, it becomes an independent supply, taxable at the rate of 18%, just like other services. Second thing, food supplies tussle between 5% without ITC and without ITC continues. Now, this is a long-standing battle for the food industry, that how the tax rates have to be applied in case of supply of food. Now, there are multiple circulars on this aspect. There is circular number 201 dated 1st of August 2023 for supply of food or beverages in cinema hall. It says that these cinema halls are running refreshment or eating stalls or kiosks or counters or restaurants themselves, wherein the customer either might avail the services supplied by them or take the food from those counters and eat it separately. So these are treated as a supply of restaurant services. Because the question is, when cinema hall is supplying, say, popcorn or a samosa, whether it is supply of goods or supply of service. So this circular said that this is a supply of service. Second is service by cloud kitchens or central kitchen, the kitchens, that is circular number 164 dated 6th of October 2021. It says, by referring to the definition of restaurant services, that since takeaway services and door delivery services or consumption of food are also considered as restaurant services, and accordingly, services by an entity by way of cooking and supply of food, even if it is exclusively by way of takeaway or door delivery or through or from any restaurant, would be covered by restaurant service. This would thus cover services provided by the cloud kitchens or central kitchens. There is a third circular number 27 dated 4th January 2018, which is for supply of food by a bakery shop. Although it related to application of rate for composition scheme for bakery shop, but at the same time, it somewhere down the line explained that what is the view of the department for a supply of food articles by bakery shop. It says any services by way of serving of food or drinks, including by a bakery, qualifies under section 10(1)(b) of the GST Act. Hence, GST rate of composition levy for same would be 5%. That is supply of food by restaurant, as part of restaurant services. So again, they have classified supply of food articles by bakery as part of supply of food as part of service. But for ice cream parlors, they came out through the circular, wherein they said that since ice cream parlor do not manufacture anything, they sell already manufactured ice cream. Therefore, they would be treated as supplying food. They would be treating as supplying goods, which is in the form of ice cream, and they would be liable to charge the rate at the rate of 18%, which was applicable at that time on the sale of ice cream. So now if we go through the rate notifications which have been issued for goods, for chapter number 1 to 21, which is covering food articles, except for one entry in 1701 or 1702, all the items are either nil rated or 5%. This was one of the intentions of the government also, to reduce the tax rate on food or food related items either to nil or 5%, so that it becomes easy for all the persons. So now all the food articles in chapter 1 to 21 are either nil rated or 5%. At the same time, when they are supplied as part of restaurant services, they come with 5% without ITC. But if they are supplied as part of goods, they come with 5% with ITC. This is a classic example of ice cream. Now, when ice cream is being sold through an ice cream parlor, by way of circular issued, that would be 5% with ITC. But when ice cream would be sold by a restaurant, that would be 5% without ITC. Now the question comes, what is the differentiation between supply as goods or supply as services? The intent of the government is whenever food is being supplied, which is cooked, whether it is part of the takeaway services, whether it is part of the consumption services at that premises, it is 5% without ITC. So now the question comes, if the intent of the government is there that once I am preparing a food, whether as a takeaway, since all the cloud kitchens are now 5% without ITC as part of restaurant services, at what scenario, in which scenario, the tax rate on famous paratha, which is now been exempted from levy of tax from 18% to nil rate, would be applicable? Because as per their circular number 164 dated 6th October 2021, they have said that supply of food solely by takeaway or door delivery is also covered within the ambit of restaurant services. So this still remains a question that when this 5% applicable of when this paratha or food articles which is taxable at the rate of 5% as supply of goods would be applicable, because intent of the government is to treat this industry as part of restaurant services 5% without ITC. So going forward also, although there would not be a rate litigation, but still there would be a litigation of with ITC or without ITC in case of supply of food articles. And similarly for ice cream parlors also. Coming to the next aspect of concept of intermediary, which Preeti ma'am has already taken the concept and what is the implication, briefly touching on the aspect of what would be the impact on hotel industry. See, in hotel industry, say in Rajasthan, there are many foreign tourists who come into the state of Rajasthan in peak season. And for them, the booking agents are outside the country. So up till now, whatever commission which was being paid by them to those agents which were outside the country, by virtue of section 13 subsection 8, there was no liability for RCM to be paid on such commission services because location of supply and place of supply were both outside the country. But now once this amendment takes place, the place of supply would now be the location of the recipient. So if I am paying a commission to an agent who is outside the country, the location of supplier would be outside the country, the place of supply would be my, and therefore payment liability for payment of tax under RCM would be there. So this is one important aspect or impact which would be there on hotel industry in case of scrapping of concept of intermediary under the IGST Act. The next question is benefit to be passed on. What is the actual benefit which has to be passed on? So a rate which has been reduced from 12% to 5%. On the face of it, it seems that the reduction is of 7%. But as we all know that the actual benefit would not be 7%. It would be somewhere between 2 to 3% or at max 4%. Because majority of the booking in today's scenario is online booking. And the online booking companies generally charge a commission of say 15 to 20% and they charge a tax of 18%. And now this credit would not be available. So at least, so straight away on the online booking part, the cost would be 5 plus say 3% or 3.6%. So effective tax rate becomes 8.6%. Add to that, consumables for the supply of rooms which were being provided, they would also now not be eligible. The common ITC which would now be increased would also be added to the cost of the room. So therefore, in my opinion, the benefit would be at to the extent of 2 to 3%, and in the best case scenario 4%, but not more than that in case of a hotel accommodation which is having a value of supply of less than 7,500. So this was all about the impact on the hotel industry. At the same time, when we discuss that the cost would be increased, say by way of a booking commission paid to make my trip, but there are corresponding benefits also, which is there for the hotel industry, because many of the food articles, say ghee, now the tax has been reduced from 12% to 5%. Say in case of a tax in case of a construction, wherein the cement tax rate on cement has been reduced from 28% to 18%. Say in case of a rent-a-cab services or a servicer, the rent-a-cab services being provided by the hotel, wherein they were paying tax at the rate of 5%, so they were not availing credit of the vehicle. Now the tax has been reduced from say 28% to 18%, or in case of high-end cars from 49% to 40%. Many of the food articles or the consumables, like the toilet soap or the toothbrush or the utensils which they were using in the restaurant. Now the tax rate has been reduced on, say, in the utensils case, on steel utensils from 12% to 5%. So in some of the consumables, the tax rate has been reduced. So that benefit would also be passing on to those restaurants, or say in case of accommodation services, wherein the tax has been reduced to 5% without ITC. So analysis on a case-to-case basis has to be made by the taxpayers, and then they have to see that what is the benefit which has to be passed on. And since the government has educated all the consumers, so they would be very particular that what is the benefit which you are giving, what is the amount which you have charged for that room prior to 22nd September 2025 and post 22nd September 2025. There's one other case which might be relevant for the hotel industry. Supposedly, I have booked a room, say on 5th of September 2025 from Make My Trip, for a stay on 25th of September 2025. At that time, they had charged 12% tax, and I have paid the amount with 12% tax. They have issued me a payment voucher. Now, when I would be going to stay in the hotel, the services would be provided to me on, say, 25th of September. The invoice would also be issued to me on 25th of September. So the tax would be charged whether at 12% or 5%. So in my opinion, to the extent I have come to know the facts, Make My Trip do not issue the invoices. It only issues a payment voucher. The invoice is issued ultimately by the hotel, and that will be issued on 25th of September. The supply of service would also be taken on 25th of September. So therefore, tax rate would be charged at the rate of 5%. And the 7%, if at all it is retained by Make My Trip, it has to be refunded to the customer. Or if entire 12% has been paid by Make My Trip to the hotel, that 7% has to be paid to the customer, and a reduction in liability by 7% on if at all paid by the hotel has to be claimed in GST 3B. That is one thing which is coming across hotel industry in case of past bookings, wherein the services would be provided post 22nd September 2025. I am not going into section 14, as it has already been discussed in today's session by Preeti ma'am, and might also been discussed in the earlier sessions. So this was all about the hotel industry, and I have somewhere gone beyond the impact on hotel industry while discussing section 17 subsection 2 and 18 subsection 4. But I thought that it would be relevant not only for the hotel industry, but for others also, to have an understanding or discussion on 17 subsection 2, read with 18 subsection 4, and condition number 4 to notification number 11/2017. With this, I would like to conclude my today's session, and thank you again to CGPI and the host for today, Nishanji and Shravan, for giving me this opportunity to discuss the impact on hospitality sector post GST 2.0.
Thank you, sir. Thank you for your insightful session. There cannot be GST 2.0 series analysis with a speaker discussing on 18.2 and 17.5, 18.4 and 17.2, sir. All speakers are deliberating on this, and the way you have presented that particular topic had a different thought process altogether. So, we will go for formal questions. So there are certain questions. And hotel and resort will be charging 7,500 per day on day one and less than 7,500 on other day. And again, more than 7,500 for other customers. So basically, they are telling dynamic pricing. Okay, like with the example which you gave. Will GST rate change based on actual amount charged? Or once the hotel charges 7,500, it should be continued for the entire year?
The amendment has been made from 26th of July 2018 that the tax would be on value of supply. So whatever is the value of supply on the invoice, tax would be based on that. No longer declared tariff is relevant.
Almond shall fall under food or food products. That is one question raised by. They just asked a question whether almonds will raise and will fall under foods or food products.
I guess that this is badam.
Badam.
Almond. So the badam, if it is being supplied as part of restaurant service, it would fall part in the restaurant service 5% without ITC.
Okay, if the ITC which belongs to September availed by a taxpayer in October, because it was reflected in PB of October, whether they can still utilize the ITC.
See, again, if it is belonging to September 2025, it is being availed in October 2025. So post October 2025, there might be two scenarios. Either all my rooms are less than 7,500. So that would become part of the rule 42 and used in making exclusively exempted supplies. Secondly, if I'm making partially taxable and partially exempted service, so partial reversal would be there. Or if all my rooms are more than 7,500, so I can use that ITC, because again, the concept is on the basis of availment. So if going on the strict interpretation of rule 42 and how the reversal has to be made, it has to be based on the availment part.
I have one question on the principal element part. So there are a lot of questions being raised that an air travel agent, okay, cannot say apply the same classification what an air clients is applying 5% because of the fact that they cannot be an agent for the supply what they are making. Okay. Now, a lot of agents are applying the same classification of hotels what they are charging. Like for example, 7,500 and same. Whether that is also permissible, because
they are not providing accommodation services. The person who is supplying accommodation services, he can only charge.
This is done because of the fact how margins are not required to be disclosed to the ultimate customer. So the agents are issuing an invoice using the same classification which the hotel uses. And that is being raised by a lot of department as a concern that they are an agent 18% should come on the margin, not on this. So I just wanted your insights on this, sir.
In my opinion, see, some like you have booked with me and I'm an agent. And I have a hotel wherein I have booked. So hotel would be providing 9963, but as an agent, I cannot use HSN of 9963 because I am not providing a accommodation service. I am only providing a planning service or a tour operator service.
Yes. So they cannot, they don't have a concept wherein I can trade services. So difficult travel sector as such. Fine, sir. I think Karthik Natarajan, sir, wanted to ask that question, the question which he has raised on the multiple rate. He is telling my question was on rate classification. GST on actual tariff is compound. So I just want if the Karthik Natarajan, sir, can unmute himself and ask his relevant question, the dynamic pricing question. He had a different view.
Yes, sir. Yes, sir. Thank you, sir. Sir, my question was, what will be the rate of GST, whether 5% or 18% based on the actual tariff, what I'm charging, or is it like the moment I cross 7,500 for one day in a year, it is for the full year, will it be at 18%?
No. It would be only for the room which you are supplying. It would not be like restaurant that once you charge 7,500, the entire restaurant service would go to 18%. So this concept would not be there for the hotel industry.
Okay, sir. Thank you.
I think there is no question, sir. Apart from that, 1 minute. This is also one of the common question I am seeing in a lot of WhatsApp groups also. If 5% tariff applies to a room rate, whether it is 7,499 or 7,500, is it like
5% up to 7,500.
Up to 7,500.
Up to 7,000.
Yeah, 1 minute. Vishal is requesting.
Vishal ji.
Hi.
Hello, Vishal bhai.
Yeah, I'm just unmuting himself.
Is he also there? Oh.
Sir,
Yes,
I
sir.
would not miss the opportunity to ask Arpit ji my question. So, Arpit ji is relating to hospitality, but not relating to what you covered. So, ये जो wellness services है, they have given a rate of 5% without ITC. The words used are fitness centers. Now, I am a running club who goes to the park and train people there, 20, 30 people who come, I train and I charge 1,000 rupees. So I am not a center in the sense I don't have an establishment. So whether this 5% without ITC will still be applicable, that is point number one. Point number two, something similar to that, I am not a physical gym. I have trainers associated with me. There are a lot of senior citizens who want gym services, but they cannot come to the center. So whenever they call me on an online platform and book an appointment with me, I will send the trainers to their own house, meaning the senior citizens house. तो वो जो भी exercise वगैरह कराना है वो वहां पर कराएंगे. So in these two situations where I don't have a physical setup, will I still qualify to be a health and fitness center and I will be able to pay tax at 5% without ITC, or it will be 18% with ITC?
Let me share that relevant entry which is there. Now, this is right at the bottom of my presentation, wherein physical well-being services, including health club and fitness center. So when we go through, see why we are referring to this code, because the entry which has been made is beauty and physical well-being services falling under group 99972. So this is a strict interpretation has to be taken that whatever services which are falling in 99972 are only being covered within the ambit of 999 ambit of 5% without ITC. So therefore, other services might be there which might be falling under 99997, but they would not be falling within the ambit of 99972. So now, if I read through the entry 99973, for which the question has been raised, physical well-being services including health club and fitness center. So now again, this is an inclusive definition. Although this rate, this classification is not mandatory, but since the reference has been made in the rate notification, now this becomes a binding part of the interpretation for that entry. So this entry is an inclusive entry which includes health club and fitness center. And going forward, say this service code includes services provided by Turkish baths, sauna and steam baths, solaria, spas, reducing and slimming salons, fitness center, massage parlors, etc. Now, all these names which have been given are reflective of establishments which are providing these services. Had the classification been beauty and physical wellness being services, and falling under 99972 would not have been there. So one opinion would have been that this is a very wide entry wherein all the services which are being provided by the center or not by the center are covered with it. But since they have restricted to falling under groups 99972, so therefore there is one school of thought which is going there that 99973 is having an inclusive definition, and once it is an inclusive definition, it only extends to whatever has been included therein. It would not go beyond what has been included. First of all, the natural meaning of physical well-being services would have to be taken. Second, including is there to make an extending to something which normally would not have been there. So when they are making an inclusive definition of health club and fitness center, in my opinion, a strict interpretation of health club and fitness center has to be taken. Let's take an example that normally I say mithai is taxable at the rate of 5%. So whatever there is in mithai, I would take it in 5%. But when I say that mithai includes this and this,